Hi, my name's Joshua Mahony, Chief Market Analyst at Scope Markets. We've got the new week coming in that's going to see a big focus on the US once again, following on from a week that's just gone that saw exactly that. Essentially, it was all around the US jobs market, and by and large, most of the data came in weak. Now, bear in mind that I'm recording this prior to the US jobs report, but everything that's been leading into that has been telling a story of weakness around the US jobs market. We kicked off with the JOLTS job openings number. That came in weak. We then moved on to the ADP number. That came in weak. And then we saw the unemployment claims number moving upwards. So certainly everything that we saw around the jobs market leading into Friday's jobs report came in from a weak perspective. And we'll really try and delve into exactly what that's meant for the markets and what it could mean for some of the big events for the coming week, because there will be, once again, a big focus on the US, with Wednesday bringing both the CPI reading and the FOMC meeting. So let's get into it. First and foremost, here's the big ticket items over the course of the week. We've got the jobs report for the UK on Tuesday. On Wednesday, we've got the bulk of it, really. Inflation out of China. We've got UK GDP on a monthly basis. That's the April number. We've also got, of course, the crucial CPI reading out of the US. And we've got that FOMC meeting and economic projections. Bear in mind, that doesn't come with every meeting, but it does come with this one. Also, the back end of the week, we've got PPI, so a continuation of that inflation theme out of the US. And then on Friday, to round up the week, we've got the Bank of Japan interest rate decision coming out, which by and large markets are expecting to see plenty of action around. Quite frankly, there's a possibility that we do see plenty of volatility for the Japanese yen and some of the Japanese stocks around that. So first topic of the three is the US, of course, with that inflation reading coming out on Wednesday, leading into the FOMC meeting. Now, there's two parts to this. First and foremost, are we going to get back down to target? No. Quite frankly, I don't see a way that we get back down to target this year. You can see year-on-year readings at 3.6 expected for core and 3.4 expected for headline. Those numbers are flat, and that comes despite the fact that we're expecting a 0.1 reading on the month-on-month CPI number, helped greatly by the decline that we've seen recently in terms of crude oil. But certainly, when we're looking for a move back down to target, it's not happening. And therefore, the question mark is, will the Federal Reserve look to cut interest rates ahead of that move? Do they even need to get back down to that 2% target? If they do, then we're not going to see a rate cut anytime soon. But if they don't, and if they're willing to move ahead of time and certainly act on potential weakness in the economy, given some of the data we've seen recently, and then that's the kind of thing that we need to know, because we're fast approaching that September meeting. And the closer we get to it, the better they need to inform markets on exactly how they see things. In terms of the PPI number, this is essentially input prices for businesses. We've got the headline number expected at 0.2 for the month. That'd be a welcome decline from that 0.5%. And the core number at 0.3, down from 0.5. So once again, it feels like that inflation pressure has started to ease somewhat. Now, in terms of, like I said, that headline inflation number, part of why we're expecting to see that decline comes from this volatility that we're seeing around the energy markets, the pullback for crude oil, around the fact that we're seeing easing concerns in the Middle East, with Joe Biden trying to put forward the plan for a peace deal between, or a ceasefire between Israel and Palestine. That eases things a little bit. And at the same time, we heard from OPEC recently, who essentially have come out and said, look, we're going to keep our production levels as they are. But from October onwards, we're going to allow our member states to gradually increase their output, and that will continue to push through next year. So that provides the basis for further increases in output, and hopefully that keeps a lid on prices, and certainly has done for the time being. And that's why we're expecting to see that low figure in terms of the CPI number this time around, 0.1 expected. In terms of the market to watch, let me just bring up the chart of gold. Now, I couldn't miss this one out from the weekly, because we've seen a massive collapse in terms of gold prices 23.87, something like that. They had topped out here, and now we're at 23.36. So why is this happening? Well, in part, this comes off the back of an announcement that the PBOC over in China have essentially stopped stockpiling gold, or within May, they didn't top up their gold holdings. That comes off the back of 18 consecutive months of gold builds. So does this mean it's the end of them doing that? Well, it might be, and we don't necessarily know. We'll find out in a month's time whether they do the same in a month's time. But it does take away one of the core drivers that has been underpinning the price of gold. Another side of it is the idea that we're going to be moving towards interest rate cuts from the Federal Reserve. And so what I found interesting this week just gone is to note exactly where we saw these bad news data points and see exactly what the market reaction has been in terms of the US 10-year and also in terms of gold. So the first announcement came early on the week on Monday. That was the week ISM manufacturing PMI reading. What happened? We saw weakness in terms of the US 10-year, so easing expectations in terms of tight monetary policy, or greater expectations that the Fed could cut in September. We saw upside in terms of gold. The second one around, we saw the JOLTS job openings figure. And once again, we had seen some weakness coming into play here. And that's when gold started to pick up once again. And again, we saw the 10-year moving towards the downside. We saw the ADP number coming out weaker than expected. Again, that really kicked things off in terms of gold. We saw the 10-year moving lower once again. And then the unemployment claims. Following the pullback, we then saw gold pushing higher once again, and we started to see the 10-year moving a little bit lower, but ultimately we'd seen a sort of range-bound market for the 10-year at that point. What's happened since? Well, we can see in terms of the price of gold, we've seen a big pullback, but in terms of market expectations or market valuations and pricing for the 10-year, that essentially has remained within this range bound move. So what we can see here is that this collapse in gold has not been driven by expectations that the Federal Reserve are going to be more hawkish. Instead, it's being driven by, like I said, what's happening over in China and fears around a cutoff of a major demand source, which is essentially the central bank over in China. So this provides the basis for a potential catch-up play if we are reminded once again by the jobs report that we are going to see the Federal Reserve potentially coming out of a relatively hawkish stance. This is going to be announced or released after the jobs report. So you probably already know exactly how this plays out. But certainly, essentially, this does give us the basis for markets to know exactly what will happen in different eventualities. And why is this relevant around this coming week's events? Well, okay, so let's look at the inflation gauge. US CPI, if it comes in relatively hot this time around, then it's going to make people more fearful around the idea that the Federal Reserve aren't going to cut in September. They're going to have to continue to hold off. What would that do? That would likely drive up the US 10-year, and that would likely drive down the value of gold once again. And then we'll be able to look at this wider context and say, okay, well, we've rebounded from this support level here. Let me just get rid of these lines now. Make it a bit clearer. Okay, so what have we got? We've got a bullish trend. We've rallied into a new high here. We pulled back, found support on the 76.4, I believe that is. Yep, at 2318. Tapped it 2 days in a row, rebounded, set a new higher high in relation to this swing high that we have here, 2364, and now we're pulling back. So for me, there's a good chance what we're seeing here is a retracement, and therefore we're going to be set on our way to move higher. But what we need for that is further economic weakness in terms of inflation data, a dovish FOMC stance on Wednesday. Those are the kind of things that could set gold on that bullish trajectory once again. And until that happens, we're seeing concerns around this whole China thing really dominating. But like I showed you with that 10-year overlaid, this is not being driven by what we have been seeing driving it over the course of much of the week, which is the optimism that we're going to see a more dovish stance from the Federal Reserve. And therefore, maybe we do see some movements over the near term over some fears around China, but I don't think that fear is going to dominate over the course of the coming week. This is a news story, and those flows have been playing out. That lack of buying pressure from the PBOC has been playing out over the course of May, but we still managed to see it hit a record high. So we're pulling back. This 76.4 fib is going to be absolutely key. And if we do see weak data in terms of the payrolls, we'll see already in the jobs report, but weak inflation data and a relatively dovish stance from the Federal Reserve, that's what would be needed to send this towards the upside once again. Until then, a breakdown below 2332 and in particular 2314 would point towards a wider pullback coming into play and a protracted move lower for gold. Next, I wanted to bring to your attention the UK data. Okay, so we've got jobs data on Tuesday. We've got a whole host of alternative sort of tier 2 data, tier 1, tier 2 in actual fact. I mean, we've got GDP on a monthly basis coming out on Wednesday alongside industrial production, manufacturing production. We've got that year-on-year GDP figure. So plenty to sink our teeth into. And once again, it's a case of, bad news is good news. Good news is bad news when we're looking in terms of equity markets. So what are we expecting? Average earnings and average earnings excluded bonuses, both expected to see significant declines. Now, this is notable because by and large, they have been flatlining for a while now. And the idea that we're going to see a significant decline in terms of that employment change figure and a decent chunk taken off the average earnings figure, bearing in mind it's still way too high, but nonetheless, if we do start to see an unwinding in terms of that figure, then some of that underlying inflation pressure eases, and therefore people become a little bit more confident that the Bank of England is going to be able to move sooner rather than later. In terms of the chart I wanted to show you here, it's showing exactly that. So we're looking in terms of pay or wages, wage growth, the impact on inflation, and you can see here that we have got that inflation decline in the blue line, but the wage figure still remains far too high. We need to see that moving towards the downside. The benefit of it, though, does come with the fact that we've seen real wages moving into positive territory. It's over that 2% mark. What do real wages increasing mean? Well, higher real wages means that people have more money in their pocket relative to what they're spending the money on. So therefore, we did see a deterioration in the quality of living in the UK, where we saw the price of goods rising at a faster rate than people's wages. That has flipped, and that should provide the basis for increased demand going forward. People feel a bit more flush with cash, and they're able to go out and spend. That doesn't necessarily help things from an inflation perspective, but certainly for this week, we're going to pay a particular attention to that average hourly earnings figure. If we do see that moving towards the downside, it's going to give us greater confidence that the Bank of England are going to think that those underlying inflation pressures are easing. What would that do in terms of the FTSE 100? Well, the FTSE has been under pressure as we're looking to close out the week. Let me just bring that up in the full screen. So we can see here that by and large, we've seen the FTSE 100 essentially sort of tracking lower over the past 3 weeks, I would say. And more recently, we've seen a rally back up. This was on the peak here, was overnight on Friday pre-market, rallied up into this 61.8 Fibonacci level and breaking down towards your 82.37 level. If we break below that level, that essentially points towards this being almost like a flag. It's not a flag because it's too protracted in nature, but if we're looking at this pattern here, you could say it's a rising wedge. So we see a sharp decline, rising wedge, a breakdown through trendline support. Crucially, if we see a breakdown through this 8226 level, 8228, then that points towards further downside coming into play once again. But at the moment, we're holding on to that support level. Certainly, if we do get into next week and we see a decent decline in terms of that average hourly earnings, and if we see some weakness in terms of the jobs numbers, that could give people a little bit more confidence that we're going to see the Bank of England's hand forced essentially, and that could give us a bit of an uplift. But certainly, over recent weeks, we have seen this in a relatively bearish trajectory. And as things stand, that rally and breakdown points towards a possibility of further weakness going forward, particularly if we see that 8228 support level broken. And then finally, I wanted to bring up the Japanese data crucially, really, it's the Bank of Japan interest rate decision overnight, Thursday into Friday. Generally, this can come out at different times. So whilst we have got a time associated, this is UK time, 5 a.m. It often comes out at 4:30, 5. So a little bit more unpredictable from that perspective. But this looks like a really, really interesting meeting because of the fact that we have expectations that we could see something, some sort of change. We heard a report earlier in the week from Bloomberg saying that the Bank of Japan could cut their bond purchases, trying to drive up the value of the Japanese yen. This comes after a period of significant and costly interventions from the BOJ. Now, that growth in terms of expectations could mean that if they don't cut bond purchases, then we could see the Japanese yen coming under pressure once again. So it's likely to move one way or another. We're also seeing people pull forward expectations in terms of a rate hike from the BOJ, again, trying to support the yen. And really, it comes down to the inflation perspective. We have seen cash earnings moving towards the upside, up to 2.1% recently. There was a bit of a warning recently from one of the BOJ members that if they don't see strong consumption data, then we could see floundering inflation. But nonetheless, at the moment, markets are becoming a little bit more confident. We can see in terms of expectations for this coming year, essentially, or over the course of 2024. The expectation is that we're going to see a rate hike in July now. So that first rate hike priced in essentially 58%. And then at the back end of the year, you can see that October is where we expect to see another rate hike. Bear in mind, they only move in 10 basis point moves. It's not the 25 basis points we see elsewhere. But that theme around potential rate hikes, the potential for cuts to bond purchases, that's the kind of thing that could provide the basis for some strength for a currency that has really been under pressure over the course of the past year, certainly over the course of this year in particular. So let's look from a wider perspective. Look, this is the trend, right? It's a massive bull trend, but it's the kind of thing that has driven the price up to levels where the BOJ have decided to intervene. Once again, you can see some of these sharp movements. Let's just move out here. So you can see these big sharp movements around that 160 mark. We saw it once again at 158. And so we've seen a more sort of tentative approach since then. There's real gradual ascent with these higher lows in play. And at the moment, that still does remain in play. You can see that we're rolling over. We came into the 76.4 fib. We've rallied into your near-term resistance level, which is here, 156.5 essentially. And now we've sort of weakened. So are we going to fall back into the 76.4 fib level at 154.6? and trendline support, or are we going to set a higher low here with a fib retracement? That's probably the 61.8 by the looks of it. Yeah, so we've pulled into a deep retracement, seeing a bit of strength here. Essentially, I think that, we could quite easily sort of track sideways as we head into this meeting, and whether we see those bond purchases cut or not could determine whether we see that next leg higher back up to the 158 mark, or crucially back down through support 154.5 and through trendline support. And that could potentially set the groundwork for a period of strength for the yen if we see them coming out in a relatively hawkish stance and talking about potential rate hikes and cutting bond purchases. That could change the narrative for the Bank of Japan, for the Japanese yen. Maybe it doesn't. Maybe they don't do that. Maybe they continue to take a relatively cautious approach, given the ongoing inflation concerns in the country, the potential for them to essentially utilize this period to jumpstart the economy after years of disinflation and below target inflation, below target wage growth. They need to utilize this period, and maybe they hold off for longer, but maybe they don't. And maybe this is the turning point. So absolutely key week ahead for the Japanese yen in particular. And certainly Friday, despite the fact that Wednesday is the big event in terms of the markets. Everyone's going to be looking out for what's happening from the FOMC with the US CPI Friday, and the Bank of Japan interest rate decision could be absolutely crucial in terms of setting sentiment for one of the key underperformers. And bear in mind, I like to trade against against very weak markets, particularly very consistently weak markets. And I like to trade for things that are consistently strong. Well, the Japanese yen has been one of the weakest, and that has been very consistent. So the question mark here for me is, do I need to change that thesis? And Friday should tell us exactly that. I hope this has been useful. Make sure to check out more of our videos. We'll be providing more around all of the key events, also previews to earnings and week aheads like this. Make sure to subscribe and click that like button. It really does help us as we try to grow the channel. Thanks a lot.